Today we are reviewing Snowflake stock, and now it is one we have covered before. However, there are a few reasons why we want to take a look at this review. Now, firstly, the CEO, as we can see here, he has purchased over $5 million worth of shares last week. Now, we have heard some unconfirmed reports that this was part of his compensation package. However, we still do believe this to be a bullish signal. And the second one that we do want to point out, now whilst we do typically run through this valuation model later in the episode, we want to point out that it does look severely undervalued, purely based on Wall Street, who are showing 31% of upside. So those are the two reasons, and we do want to first say that over the last month, this stock has plummeted down around 30%. We'll refresh our memories as to why this stock has taken a beating over the more recent period, and it does trade towards its 52-week lows. Now, as well as this episode, we're also going to cover two ETFs for those that don't prefer to just buy single stocks. We're going to look at VGT, Vanguard Information Technology ETF. And for those who don't have access to this specific ETF, one that is fairly similar, which is Invesco EQQ, depending on the accumulation or distribution. The alternative to EQQ is EQGB. And there are a few other things that we want to draw out from this company. We are going to look at their latest investor presentation, and we're going to take a look at not just what institutions have been doing quarter on quarter, but whether or not overall they have been buying more shares. And now we have FY24 numbers, and this will be incorporated into our analysis, as well as not just the intrinsic value, but when we do take a look at that discounted cash flow model, we can see based on their latest free cash flow whether or not it is a buy, and we can see it has increased 57%, and we'll factor this into our low, medium and high targets moving forwards. So starting off just very briefly then, it is down 30% over the last 30 days as we can see. Year to date as well, it is down, and when we do look extended over the last 12 months, we can see nonetheless it is up 20%. When we extend it over the last 5 years, we can see it has gone from a position of around $254, and whilst it did hit its all-time highs twice at just under $400, it is now sitting at the $161 mark. The market cap sits at $54 billion, and we can also note the forward P is very high, and there are reasons for this. A lot of growth in the numbers, not just historically, but also baked in. So let's just very quickly look at the institutional side. The ownership does sit at 65%. We do see a fair amount of selling by the institutions over the last 12 months at around $6 billion, but we see nearly $8 billion worth of buys. So we know over the last 12 months, as well as the latest quarter Q4, institutions are buying more shares of Snowflake. Now, in terms of just briefly looking at their top line, we can see a lot of strong growth over the last 5 years. It has increased more than 10 times from $265 million to $2.68 billion. And on top of that, we do see those year-on-year increases to their top line, which is always very positive to note, especially for fast-growing companies. The only thing we would point out is they are yet to make a net profit. So right now, given the brackets, we do see every single year they have made a net loss. So something just to take into consideration. But when we do factor in on the free cash flow, we do have some better news. In terms of the health, well, we have the latest numbers now from their latest quarter. So it has increased their cash position from $434 million to $3.8 billion. Now, for our health check, we also need to look at the total debt numerically and directionally, and we can see that it has gone from around $211 million to $288. So yes, their debt has increased, although marginally, but we do see that their total cash is very sufficient to pay that off. So no worries when we do look at that total debt to net debt EBITDA metric. Now, there are others in this industry. We have Cloudflare, we have MongoDB, VeriSign, Okta, which is a very strong company, as well as GoDaddy. Now, when we look at the performance over the last year, we do see that in actual fact, it is one of the worst performing, even though it is up 20%. And when we extend this to the last 5 years, we can see it is one of the worst performing, down 36%. So remember, this isn't a very undervalued company. Wall Street are forecasting some very strong gains, but it is for us to make that decision whether or not we believe it is a strong company. Now, before we jump into the metrics to take a look at this, a few things we want to just note. Firstly, we have released our latest free weekly article. If you do want to gain access to this, all completely free. Click on that pinned comment and you gain instant access to all of the articles we have written over the last few months. Now, looking at their essential investor presentation that was released not too long ago, a few key highlights. So we can see year on year their growth looking very strong, 33%. Although when we do look at the metrics, you will note this revenue has slowed down from triple digit growth down to double digits. We see their net revenue retention looking very strong in the triple digits, and we can see some very good momentum with their largest customers, and their product margin is very healthy at 78%. So breaking that down, their top line revenue, as we can see over the last 3 years, very, very strong. More recent period, 36%. And looking on a quarter-to-quarter basis, again, there is growth there. So this isn't a company that is lacking in terms of that. But as we will come on to the valuation, it is key to understand, given this trading at a high forward PE, whether or not right now is the best time to buy. We also see since Q1 of FY24, their customer commitments have increased year on year with a very rapid growth from Q3 24 to Q4. And when we take a look at their customers, they are also increasing customers. And remember, this is over 1 million product revenue from 331 up to 461. So all the metrics are pointing to positive signs for Snowflake. And finally, we do want to point out that they are also improving their gross margin, as we can see. 4 percentage points over the last 2 years, 74% to 78%. And this is very positive when you combine that with the fact that they're not just increasing their margin, but also their top line revenue is increasing. So in terms of the metrics, so as always, my personal preference is to focus on the free cash flow. And in 2019, it was free cash flow negative. As we can see, they turned that tide officially in 2022, positive 19 cents. 2024 at 229, looking very strong. 2025, they are expecting that to increase even more. So it is moving in the right direction. And this will be important when we do factor in and look at our valuation on the 3 different models, the low, medium, and high. In terms of sales growth, well, triple digits, as we did mention in 2020, 2021, and 2022. It is starting to slow down. Now, this was one of the reasons, as we can see here when we take a look at why the stock did fall. We did see that after releasing their Q4 report, they did lower their forward guidance, and that really hurt the stock. But also the fact that their CEO did step down and a new CEO was to take his place was another reason, or in fact maybe the large driver behind the initial 20% drop that was happened to the top line. Now, in terms of taking a look at the total sales for numerical reasons, 100 million in 2019 to 2.81. Shares outstanding, now just note that they are doing the opposite of we typically like to see on the channel through share buybacks. They have, as we can see quite clearly, been issuing shares. So your position, if you were a shareholder in 2019, not only has the share price gone down, but we can also see your position would have been diluted. Now, looking at the ROIC, again, given the fact that they do have a net loss every single year, we do see these negative numbers. So again, something to consider and factor in when you do look at our margin of safety levels. Now, positive sign is the free cash flow. It has gone from triple digit negative in 2019 to positive over the last 3 years. It is moving definitely in the right direction. And these last 2 years do show some very strong growth that is attractive to investors or potential investors. And the operating margin, given they have made a net loss, makes sense to see it negative. But the plus sign to take from here is that it is moving in the right direction, getting smaller and smaller. And we would like to see over the next year or two that this company does start to turn a profit. In terms of net debt to EBITDA, while the earnings before the interest, tax, depreciation, amortization shows us that balance sheet strength, just backing up and justifying when we did say there were no worries. As we can see, over the last 3 years and 2025 expected, 0 days for the company to pay off all of their debt net of cash on hand. So again, looking very, very solid. Now let's get into the valuation. As always, if you do enjoy the content and value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through the intrinsic value, which is the average of all 4 of these models. And as we're about to find out, the DCF model is the one we are using in today's episode. And whilst we do have this as our calculated intrinsic value, we do want to show how we got to that number. We have the free cash flow growth year on year. So we do now get the 2024 number, 779, and we can see 57% growth from the previous year. Now, on average, 79%. What we have gone for is a 25% growth rate, which, as we're about to find out, we do believe to be a medium level. Based on that, with the discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and this leads us to $226. Now, if you believe that that is too high, 25% for the foreseeable future, although do note the last 2 years have been very strong, you may want to go for what we deem to maybe a slower rate of increase at 20%. That would then give an intrinsic value of $165. And as we can see, that would lead to 2% upside. Now, for those who are a lot more optimistic and believe that 25% is still too low, at 30%, as we can see here on the left, it does give an intrinsic value of $311, signaling 92% upside. Now, taking it to the intrinsic value calculator on the next slide at 25%, we do get $227. And we can see now with the current price at $161, we always use our margin of safety. So our margin of safety, we always use 10%, and we start off with that if we believe it meets 3 criteria, which is a wide moat, strong financial metrics, and good forward-looking data. We then keep going till it's near the current trading price, and we can see for today's episode, it is giving a very strong 25% MOS level, and at 30%, it isn't quite there yet, but it isn't too far off. So around 25 to 30% for today's episode, but as always, different investors based on their risk level, based on their investment thesis, and maybe their time horizon will have different MOS levels. In conjunction with that, as we mentioned at the very beginning of the episode, the reason why we did want to dive into it, not just because the CEO had bought 5 million worth of shares, but also Wall Street do believe this to be significantly and severely undervalued, with 31% upside showing strong signs of a buy now. As always though, do let us know your thoughts in the comments below. And as we did mention at the beginning of the episode, for those that don't necessarily like to invest in just one single stock and want an ETF that maybe also holds that stock, as we show it does, VGT, Vanguard Information Technology ETF is definitely one to consider. I also quite like it given the fact that it is 0.1% expense ratio, so that is something that I can get behind and invest. Now, in terms of their holdings, as we're about to find out, their largest holding by quite some way of 18.21% is Microsoft. You also have Apple, Nvidia, Broadcom, and AMD within their top 5 holdings, but we can see the largest chunk is made up by Microsoft and coming a very near close Apple. Now, again, this does hold Snowflake, so if it is one that you are interested in, but again, you don't like to invest solely within those essential individual stocks and take on that risk, we can see if we take a look at page 4 of their breakdown that Snowflake in Class A is around 0.4%, so it may come down to the exposure you want within individual companies, and as I said, ETFs are a very great choice. Now, investors who do not have access to VGT, whether they're not from the US, there is also an alternative, in my opinion. It's a very positive one, EQQ, which is essentially the NASDAQ 100, as we can see here. Again, whether you want an accumulating fund or essentially one that is distribution, you also have EQGB, the exact same fund. The only thing I would say is 0.035% is a little bit too high, but again, when we have looked at ETFs on other episodes, you can get some for those non-Europeans, or in fact non-US Europeans, at lower than 0.35%, notably VUSA, which tracks the S&P 500. So when we take a look at their holdings, fairly similar as we can see here. You have Microsoft at 8.8%, Apple at 7.42%, Nvidia, Amazon. So a little bit different, but again, it does cover all of those stocks as well. As always though, do let us know your thoughts, whether or not Snowflake is one you are looking to add. Maybe you do prefer the ETFs, whether or not EGT. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.